What if I told you that every major currency collapse in the last century, from the Weimar Republic in the 1920s to the Asian financial crisis of the 1990s, and even the hyperinflation spikes of recent decades had one thing in common? It wasn't the people crying in the streets, it wasn't the governments printing money, and it certainly wasn't the banks that claimed to have it all under control. It was five specific assets, five financial lifeboats that consistently preserved wealth when everything else failed. By the end of this video, you'll know exactly what these assets are, why they survived the worst financial storms, and how you can position yourself today before history repeats itself. But first, to understand why these assets work, we need to understand the collapse itself. Setting the stage, currency collapse is more than just inflation or devaluation. It's the erosion of trust in governments, central banks, and the money in your wallet. In 1923, Germany experienced the infamous Weimar hyperinflation. People burned banknotes to stay warm. A loaf of bread that cost 1 mark in the morning could cost 4 billion marks by the evening. In 1998, Russia defaulted on its debt, triggering the ruble to collapse and wiping out savings overnight. In 2001, Argentina's peso crisis forced families to trade their cars and electronics just to buy groceries. And yet, in each of these disasters, a handful of assets, not necessarily glamorous or headline-grabbing, emerged virtually unscathed. These assets are not just relics of history. They are repeating patterns, and what history has repeatedly taught us is, currency collapses are predictable in their unpredictability. So, what are these five financial lifeboats, and why have they survived every currency collapse for the past 100 years? Asset number 1: gold. The timeless hedge. Gold is the oldest survivor of financial crises. Its story is not just about jewelry or central bank reserves, it's about human psychology. During the Weimar Republic, as marks became worthless, gold retained real value. Families used it to buy bread, rent, and even train tickets. In fact, by 1923, the gold price in Germany effectively multiplied billions of times in local currency terms. Similarly, during the 2008 financial crisis, investors flocked to gold as paper assets crashed. The metal not only retained value, it soared. Why it survives? Gold is finite. You cannot print it at will. It has intrinsic value, recognized globally across cultures and economies. It is portable, unlike land or factories. Even today, with cryptocurrencies rising, gold remains the go-to hedge during periods of extreme market volatility. Modern parallel. According to the World Gold Council, central banks added a record 1,136 tons of gold to their reserves in 2023 alone, almost double the previous decade's average. The lesson even the biggest financial institutions know: when fiat fails, gold doesn't. Asset number 2: real estate. Shelter in times of chaos. The second asset that survives every currency collapse is real estate. Tangible, immovable, and essential. During hyperinflation in Argentina, families invested in apartments and farmland. Those who kept pesos in banks lost almost everything, but those who converted wealth into real estate preserved and even grew it. During the Asian financial crisis, Thai and Indonesian real estate values initially plunged, but prime locations and agricultural land recovered quickly. Those with physical property had something no bank could erase overnight. Why it survives? Real estate is essential. People always need shelter or land to grow food. It's a hard asset, immune to currency printing. It provides leverage opportunities, allowing long-term wealth preservation. Modern parallel. Today, real estate markets in countries like Dubai, Singapore, and Switzerland continue to attract foreign capital during turbulent economic times. As currencies fluctuate, property often acts as a hedge of necessity, preserving value where paper money cannot. Asset number 3: stocks of essential businesses. Wealth that works. The third survivor is equity in essential businesses, companies that produce necessities like food, energy, or medicine. During the Great Depression of 1929, luxury goods collapsed, but companies like Procter & Gamble, Coca-Cola, and utility providers endured. Their services and products were always in demand. In Zimbabwe's hyperinflation, the local stock market initially cratered, but businesses tied to agriculture, mining, and consumer staples continued to provide returns for investors who held patiently. Why it survives? Essential companies cannot disappear, even if their stock price temporarily collapses. They generate real cash flow, which provides intrinsic value beyond market sentiment. They often pass on inflation costs to consumers, preserving profitability. Modern parallel. Consider the COVID-19 pandemic. While tourism and airlines plummeted, grocery chains, energy firms, and pharmaceutical companies flourished. Owning real businesses rather than speculative assets remains a time-tested hedge. Asset number 4: foreign currencies, diversification across borders. The fourth survivor is foreign currencies, but not just any currency. Historically, the strongest assets have been those backed by stable economies with low debt and high reserves. During Argentina's peso collapse in 2001, those holding US dollars or Swiss francs preserved wealth almost entirely. Banks that forced local currency conversions wiped out millions. Similarly, during Turkey's lira collapse in 2018, foreign currency savings, particularly the US dollar, protected families from losing their purchasing power overnight. Why it survives. Diversification reduces exposure to a single failed government. Stable foreign currencies act as a benchmark for purchasing power. They provide liquidity when local banking systems freeze or fail. Modern parallel. Even today, in nations facing political and economic instability, citizens flock to USD/CHF and EUR as safe havens. The pattern repeats. When local fiat collapses, foreign currency holdings act as a lifeboat. Asset number 5. Commodities inflation-proof essentials. The fifth survivor is commodities beyond gold. Things people cannot live without: food staples, oil, and critical industrial metals. During the 1970s, stagflation in the US, the dollar's value plunged, but commodities like oil, wheat, and copper surged. The same was true in Venezuela in the 2010s, where basic food and energy commodities became more valuable than cash savings. Why it survives. Commodities have intrinsic utility. Unlike fiat currency, prices rise naturally in response to currency devaluation. They are globally demanded, insulating them from local collapses. Modern parallel. With inflation in the US, Europe, and emerging markets hitting multi-decade highs, commodity prices have skyrocketed. This reminds us that when paper fails, real-world essentials remain valuable. Patterns across history. Notice a pattern in every currency collapse. Weimar, Argentina, Russia, Zimbabwe, Turkey, Venezuela. These 5 assets consistently preserve wealth. It's a combination of tangibility, gold, real estate, commodities, essentiality, real estate, stocks of essential businesses, commodities, diversification, foreign currencies. Time and again, governments try to intervene with stimulus, debt restructuring, or currency reforms, but the same 5 assets survive where others fail. Failed fixes. Printing more money, Weimar, Zimbabwe, just accelerates collapse. Currency pegs and debt restructuring, Argentina, Russia, provide temporary relief but often fail. Reliance on financial institutions alone is dangerous. Banks freeze, fail, or get nationalized. History leaves no ambiguity. These 5 assets are the true wealth preservers. 3 key takeaways. 1. Diversify across asset classes. Don't rely on cash or government promises alone. Gold, real estate, essential equities, foreign currencies, and commodities have proven resilience. 2. Prioritize tangibility and utility. Assets people need: shelter, food, energy, and essential services survive even the worst collapses. 3. Learn from history. Don't repeat it. Currency collapses often follow similar warning signs: high debt, uncontrolled money printing, and loss of trust. Position yourself before the storm. Final warning and open-ended thought. Here's the uncomfortable truth. We may be closer to another major currency shock than most people realize. Debts to GDP ratios are at historic highs. Inflation persists globally, and trust in fiat money is eroding. Will history repeat itself? Likely, but those who understand what survives and why will be the ones who navigate the storm with wealth intact. Call to action. If you found this video eye-opening, hit that like button, subscribe for more financial deep dives, and share it with someone who needs to protect their wealth. History doesn't have to be cruel if we learn its lessons. Start today, because the next collapse won't announce itself, it will arrive silently, just like the last one.